Hello and welcome to the next episode of the Tax Hour, where we're talking pre-budget insights. I'm joined by Paul O'Reilly from Jerram's Mortgage and Finance, Kate Moon, who heads up our tax team in Jerram's, and Jamie Ellis from Jerram's Financial Planning. This has been a very long time coming, so I'm going to jump straight into tax stuff. The first thing that massively grabs me, we've had about 4 months run up to this budget. Mm-hmm. Before, I think I tried to figure out when was the last time we had that length of time. I have no idea when it was, but the last one we had about 2 months. Mm-hmm. So we've been talking to lots of people about lots of different ideas when we've had so much time to plan. I think there's quite a lot of scaremongering going on.
Sometimes they make it sound potentially worse than it's going to be. Might be my negative view on it, but I feel as though then whatever changes come in, everyone might think, oh, well, it's not as bad as what I thought it might be. So I do feel as though there's a little bit of that happening. And we saw this in March 2020 when we went into the lockdown, that first lockdown. There was a lot going on about capital gains tax and people were panicking and planning and restructuring. And then it didn't really deliver on what it said it was going to do. So I'm always a little bit dubious as to whether it will actually be as bad as what they suggest it will.
Yeah, so I think in March 2020, the biggest thing for us from a transactions tax side was the reduction in, the change from entrepreneurs relief to business asset disposal relief. We had £10 million where you could sell a trading business at 10% CGT rates. Mm-hmm. Now they reduced that in 2020 to 1 million.
Yep.
So let's talk CGT to start with, as we're there.
Yeah, CGT is going to be a big one. That's where all the changes are going to be, I think. I don't think income tax is going to change. The only thing with income tax is I think the rates will be frozen, which technically is a tax increase because they haven't increased them tax-free threshold. Other than that, all capital gains.
They're not changing the personal allowance rate, are they?
No, I don't think personal allowances are going up. I don't think your higher rate threshold's going to go up. So I don't think anything will change there. But in effect, if you look on it in terms of the cost of living and people having to put salaries up, technically that's a tax increase. Yeah. There's more and more people now. I can't remember the statistics, but it used to be something like 17% of the population was a higher rate taxpayer. I think you're now sort of 45% of the population because so many people now fall into that higher rate bracket where they haven't aligned the thresholds.
So capital gains tax, the first thing I've literally in the last few days, there's been more talk about completely scrapping business asset disposal relief, which obviously means if they didn't change anything else, we're into 20% tax rates for most people. Obviously, if they then do further changes, those CGT rates are going to be massively higher.
Yeah, I almost think getting rid of, I still call it entrepreneurs relief, getting rid of business asset disposal relief would actually be preferable, I think, to changing the rate from 20% to 40%. I think that would affect a lot more people, whereas I think actually if you're selling a business and you're getting a massive payout, then a 20% tax rate isn't too hard to swallow. I did read one article that suggested that business asset disposal relief, the limit was going to go up to 5 million rather than be scrapped, which was an interesting article. I know. And I can't imagine where that came from. But I've had a few clients mention it to me as well. So there has been a little bit of publicity around that. But even if they get rid of business asset disposal relief, I think the intention was always to replace it with something. And there used to be retirement relief back in the day, which is a similar sort of thing, but aimed at people that are actually retiring. So rather than your young entrepreneurs going through life and claiming it on partial sales and things like that, I think it's more about the end game and your final sale, you'll get it. But it'd be interesting to see what they do there.
Yeah. So have you read that IFS report from a couple of weeks ago? If you're not as tax nerd as I am, then you haven't, have you?
No, I haven't.
No. So the IFS did a report entirely around CGT. Yeah. They came up with, I think it was on the 6th of October, they came up with scrapping BADR and in favour of having some sort of investment relief. So rather than getting tax relief on the way out when you're ceasing a business, have tax relief to actually start a business and help it grow.
Okay.
Which I think makes a lot of sense. They suggested aligning CGT rates with income tax, which we've heard before. The OTS did that years ago as well. What else did they do? An exit charge.
Yeah.
Okay.
So if you leave, excuse me. So if you leave the UK, because at the moment, at least on shares, if you leave the UK and you're non-resident, you don't pay CGT. So they were saying have an exit charge as well. But I think Rachel Reeves has basically discounted that in the last week or two, or suggested it wouldn't happen. I'm trying to think what the other issues were. So those were the main ones, though, the increasing CGT rates alongside income tax, which could mean reducing income tax but increasing CGT so that they line up.
Yeah, I was surprised how little revenue capital gains tax actually brings in. Actually, I think I saw that snippet of the report. Yeah. I would have thought it accounted for a lot more of the overall tax, but I think maybe that's just the sector we work in. I suppose we see capital gains tax more than we do any other tax.
Exactly.
So to me, it's always seemed like this huge earner for the government, but actually it's not.
I think it accounts for 1.5% of the revenue, and actually in the decade up to 2022, only 3% of the UK population actually paid CGT. Now, obviously, that's going to go much higher. I did actually see that report. I think it was done by the University of Warwick, and they were talking about moving back to Nigel Lawson's old indexation of CGT.
Yeah, that was one of the other things, indexing it.
Yeah, which makes sense and comes back to this whole stealth tax.
Yeah.
You know, it was the Labour government that were criticising Rishi and saying that he was the one imposing these stealth taxes, and then only today there's talk of Labour looking to extend the freezing of the thresholds from 2028 to 2030, thinking that will bring in a further £7 billion a year. So, you know, it's very easy for them to indirectly apply these stealth taxes as the cost of living and everything is becoming more expensive.
I think for me, the biggest thing reading the IFS report is you can't really change one thing. So everyone's talking about aligning CGT rates. Well, we suddenly have 40% instead of 20%. If you do that, everyone's just going to leave, surely. They'll just go offshore if they've got enough money. And if the gain is enough.
So they'd have to bring the exit charge in.
So they have to bring an exit charge in,
yeah. I think the other one as well was actually not rebasing CGT at date of death.
Yes.
And actually bringing the assets back into the estate and then providing an allowance for the base cost.
I must admit that has always been really generous. You know, without playing devil's advocate and being against the taxpayer, I've seen estates where there's no inheritance tax because it's below the threshold, but something that's got a base cost of 50,000 is suddenly rebased to 300,000. And you think there's no tax on that growth in there. It's always really surprised me that is the case.
That works well though with trading businesses because you get your business property relief, so you don't pay IHT, and you get your rebasing. We've got a client at the moment who's got a bit of a headache because they've got a property portfolio that's been left to them in a company. So they've got IHT, 40% on, I think let's say the value is around 10 million. So they've got £4 million IHT to find. Unless they do something like liquidating or something and selling all the properties, they're going to have to take a dividend, which would be almost 40%. So they paid IHT. Yes, they might have a rebasing, but that's rebasing of the shares.
Yeah.
The company still has capital gains, corporation tax on that, and then they've got to take it out as a dividend.
Yeah.
So for them, they have effective tax rates like 40%, 80% or something stupid.
Yeah.
So it works in some places.
It does.
And other places.
I think if you qualify for a leaf, it's a little bit different, but I think where your estate is naturally just under the IHT threshold, I can't imagine why they have still allowed that to get rebased. That's the bit that confuses me. I think once you're over that threshold and it's just reliefs that are applying or not applying, I think that's fair enough. But estates that are smaller than that threshold, it just seems a little bit
I agree,
bonkers, misaligned.
So, but I think for me, the main thing is a single change just isn't going to work. We need some form of reform.
I don't think they've had enough time to bring it in.
No, that's to me the biggest thing for a lot of this tax.
Because of so many different factors coming in, I just don't see how they will have had time to consult on it, to change the legislation. I mean, capital gains is bad enough. IHT, you'd need at least a year, I think, because the IHT legislation is so old and historical. You've got to go through tons of it to actually get to the main crux of it. And I just don't think they've had time to do it.
Well, I mean, what's the IHT Act is 84. CGT Act is 92.
Yeah.
Obviously, they've made changes via Finances Act ever since. So it's really complex system to just say, we're just going to do this. And
I think
we'll
one
get the results we
change
want.
means however many rewrites and things like that. I just
Yeah.
don't see. I don't think that they're organised enough, and I don't think they've had enough time.
No.
So I think yes, they might be putting feelers out by making small changes, but I'm not convinced that they'll be able to implement the full thing as they'd want it to be. Without
The
more
obvious thing
time.
to me was a consultation on CGT, a proper consultation on reform. Okay, maybe you do.
Which they haven't
small
done
things.
yet.
No.
And you think if it hasn't happened yet, surely that will have to happen.
Yeah.
But I think with any government, obviously they would like to implement their manifesto and ideas at the first possible opportunity.
Yeah.
Because obviously then inflict as much pain as you can in the short term and then hope that people forget about it or the benefits are being rewarded. But without proper policy review and, analyses, because at the moment it just seems like the analyses that have come back is actually, well, we could implement this, but actually it's going to be at a net cost. And that was the whole talk of the VAT policies. Well, actually, if all of a sudden these schools that have built the infrastructure can then reclaim, 6 years worth of VAT receipts, well, actually, well, that's going to be a net cost to the exchequer.
Yeah.
So
they don't think long term, do they? I don't think they think about the impact of it. And I mean, even if they were to say we're going to bring in these changes from the 5th of April, this is what we'd like to do, that only gives them 5 months.
Yep.
And I still don't think that's enough unless they've done some serious legwork beforehand. What that will do is if they give us the 5th of April, it's good for us as accountants. It's great for us because we've then got that 5 months to plan and structure. And whilst it does let people get through loopholes, I suppose, it does stimulate the economy.
Yep.
Because so many people will buy and sell and restructure and accelerate tax to get it in at that rate. Actually, it does give that little initial short-term boost. So I do think anything that comes in, there's a good chance that you're not going to see it till the 5th of April.
Because that's actually what I said the other day, that by giving us this 4 months or however long it's been since they announced this budget, more people have had time to say, oh, we've got a sale, let's push that ahead. With 2 months or less, if you're starting to sell, you probably still don't have time to go through due diligence exercise, all of that stuff. Whereas they've had enough time if they really want to push it, and everybody has. I mean, this is the busiest I've been since I used to work in personal tax. So, I think it makes sense that you could argue actually a lot of this is
I think they've implied it's going to be immediate to get that 4 months that you're talking about. And then actually they could give you another 5 months and get a second bite at that, which wouldn't surprise me.
Yeah, it's when they introduced the health and social care levy, that was literally an overnight introduction. Nobody thought that they'd amend NI partway through the year because of all of the payroll systems and whatnot. So it's just about being proactive. But also we are hearing stories, not necessarily of clients because they're advised, but other people who are maybe selling assets, who don't have a clear plan, who are, taking actions with their investments and pensions. And, sometimes it's better to edge on the side of caution and do nothing, because this could all be one big smoke and mirrors exercise by Rachel Reeves, and she's increased tax receipts when she could turn around and say, well, actually, we don't have the, we don't have the data yet to make a...
And coming back to the idea that CGT doesn't really generate much, which was, I think, 15 billion in 23-24, which was 1.5%. So you have to make pretty major changes to make any real difference in tax receipts from a tax like that. And unless they do the full reform, anybody could just say, well, as I've already said, you can just go offshore or just don't sell for, and maybe think, oh, we'll get a new government in 4 years and I'll sell in 4 years kind of thing. Yeah. So with CGT, you've got more...
you've got more flexibility. You've got a bit of power in there, haven't you? Yeah.
Whereas something like income tax, and I think I said this a couple of weeks ago when I gave a talk, if they just increased income tax by 1%, you'd get more out of that than you would by doubling CGT rates. And yet they've pledged in their manifesto over and over again, we're not going to increase our income tax.
I don't think they can. And I do understand your point. And you think, well, 1%, who could moan about 1%? It's the fact that them rates have been frozen for so long now. I think technically, if they were going to give you some increase in the thresholds and then add 1% on, I still think they would make on that. But I think if they're going to freeze the thresholds, then to put 1% on is a really difficult thing to do, because what you're going to do is affect all the low earners and not really impact the high earners. So they need to find a balance between that.
And ultimately, they're breaking their manifesto pledge. He's told people that he's not increasing workers on employees, income tax, national insurance, but that is an area which we'll probably come on to that's come under the spotlight because now there's increasing scrutiny. We saw what happened with Sunak and Starmer in PMQs, where he dodged the question about, well, actually, is national insurance going to increase for employers?
Yeah.
So that is another area, and especially around pension contributions as well.
Yeah, I think CGT is something that probably we will see some change. I do think out of all the taxes, it's probably the easiest to change mid-year. Yeah, because it's a transactional type thing. But exactly what change we'll see, given I think it needs proper reform.
I've always been surprised at the 100,000 threshold where you lose your personal allowance. I'm surprised that they don't bring that down, actually. Because I think your average worker, your average earner in the UK, to hit them with a 1% increase would be quite painful for most households. Yeah. But actually, when you're talking someone that's pushing more towards that 100,000 limit, I think that could be quite an easy win for them. Or to put it on the additional rate of tax, rather than 45%, 47%, or so that you are getting it off the wealthy rather than getting it off the people that are struggling. And I'm sure wealthy earners wouldn't like that. But, you have got average households that are struggling to pay their gas and heating and things like that. So you think there's got to be some sort of giving it somewhere, and I would have thought the wealthy somewhere. I think they were looking at a wealth tax at one point. They do it in Spain, where they say, well, your property is worth this, you can pay 1% a year in wealth tax. They were looking at that, but I mean, there's no way anything like that will come in anytime soon, I don't think.
And I think all the commentators who have talked about the idea of a wealth tax have all said they've never worked in any country that's tried to do it. I know Spain are doing it at the moment, but basically they don't work.
No, I should imagine the administration of it is absolutely horrendous as well. I would have thought that the infrastructure of collecting that tax would probably cost as close to the tax. I mean, they can't handle self-assessment tax returns, they get completely overwhelmed. So you think, how on earth, if making tax digital has took this long to bring in and you're still not there, how on earth would you implement something like that? You'd be talking crazy, 20 years away. Yeah.
And then the cost of actually implementing it would probably be as much as it would to actually collect the tax itself. Okay, so I think we're pretty much all agreed that we're not going to see any wealth taxes. CGT needs reform. We'll probably see something, but who knows what? Maybe just getting rid of BADR.
Yeah, I don't think it necessarily needs reform. It's just that is one of the only areas really that hasn't been squeezed. Although it has, because Jeremy Hunt reduced the CGT allowance from 12,300 to 3,000 in the space of a year. But, when you're looking at where can they further squeeze to fill this black hole, well, I think
it's an easy win, isn't it? I think after gains tax.
I think the thing with reducing it from 12 to 3, it brings so many more people into CGT, which has always made me think, how much does it cost to actually, administer these little gains? Is it really worth? For a £5,000 gain, you've now got to get someone to do tax returns and all that stuff.
Again, great for us. Never been busier. But we have seen a lot more people fall into self-assessment that have perhaps been clients for whatever reason of ours, but haven't ever had to file. All of a sudden, those people, dividend allowance has gone down, the capital gains exemptions have gone down. All of a sudden, then people are actually falling into a bracket where they need to do a tax return. And perhaps they don't know they need to do a tax return as well. The savings interest is a really interesting one, because I've never really fathomed this paying it gross, because now they pay it gross, so many people have to do a tax return just to pay over the tax. And I think, I'm not sure how much the HMRC infrastructure can cope with it. Yeah. They can't seem to process the tax returns they do now. And actually, I think you could probably say about another 10%, 15% have fallen into that bracket as a result. So that number's just going to keep on growing. I'll
talk in a minute. But we'll see even more of that with freezing the 12,000 or 12,500, whatever it is now, personal allowance. So it's just getting bigger and bigger how many people are needing to do something.
Well, state pension, there's not many state pensions now that are actually under that 12,300 limit. So
Yeah.
you kind of think where you've got your personal allowance and the state pension, some of them people are having to do a tax return. You think that's crazy.
It is.
Yeah.
Like, you know, your grandma who's got a state pension coming in and that's it, all of a sudden, she's not going to do it herself. She's going to have to find an accountant to do a tax return and then file
Yeah.
it. And you just think it doesn't make any sense.
Well, yeah, the state pension is always, it can only be paid gross physically
Yeah,
as
yeah.
well. So that's another issue. But I think the triple lock forecast came out today. They were expecting inflation to be 4%, came in at 4.1%. All of a sudden, that's added £100 million to the black hole. So I'm sure Rachel Reeves loved seeing that this morning. But, you know, this triple lock, it's just unsustainable in its current format. And this is the issue that we have now, or the government has, is that they can either push back the state pension age, which doesn't incentivise, well, it should incentivise younger people through auto enrolment to increase their contributions that they're paying. But then they're talking about such potential pension reform that actually that completely disincentivises people to save.
Yep.
So
Okay, so let's talk pensions briefly. Generally, they've said we're not increasing income tax, we're not increasing national insurance, and so you kind of think pensions are probably largely safe. Whereas actually now we're expecting employers' NIC on pensions. So that's a big change.
Yeah.
And arguably goes against their manifesto promises.
Well, they did say on the working people, and I think that's how they will manoeuvre themselves
Wiggle their way
around that.
around it, yeah.
But you know, they're trying to spur investment and growth into UK businesses. But at the end of the day, they're making it more expensive for business owners, which is either going to result in less wage increases for staff or other spending on capital projects instead of labour, skilled labour. I mean, not the Labour government, but really. Employer national insurance on pension contributions, that will be the first time that national insurance has been levied on pension contributions. And a lot of what we do is profit extraction for our corporate clients, where effectively if you draw a salary or dividends, well, you're going to have to pay immediate tax. You know, without going into it, there's various rates of tax. Whereas if you made a pension contribution where there's no link to earnings from the company, that amount is paid in gross. Obviously, it's been subject to various allowances. But if all of a sudden, you know, employer national insurance is levied on pension contributions, that's an additional cost to the employer. And it's not to say that the tax treatment hasn't been very advantageous for many years. And I think if you spoke to a lot of financial advisors on, you know, where they really can assist clients in terms of profit extraction, tax efficiently, tax efficient generation of wealth, and you know, all of these things, pensions, that would be the number one thing, really. I think they said last year if it was implemented, that would have filled a £24 billion black hole. But you obviously can't quantify which is yet to happen because people just change their behaviours.
It'd just be interesting to see it. I think it's very different where you've got a trading company or a family company where 1 year they say, right, okay, so, you know, we've got 100 grand, shall we put it in our pension? To your bog standard employer who's already got stuff on the payroll where they're having to put 5%. Actually, to whack a national insurance charge on them is quite imposing, really, compared to a voluntary contribution that you're deciding to do to avoid something else. So I almost feel like there needs to be two regimes. I'm sure there wouldn't be. I'm sure it would just be straight down the line. But for employers, and especially small employers that have perhaps got 4 or 5 people on the payroll, actually that could be quite a significant overhead, really. It's an additional cost that they haven't been able to take into account when looking at salary packages. And so, like you say, it is going to end up affecting the cash in the business. And, you know, can they afford to keep the staff? Can they afford pay rises? So I think economy-wise, it's not really that helpful. But I do think from a point of view of someone making a voluntary contribution each year for planning, it's an easy win, really. Because it's still going to be cost effective. If you look at all the other taxes involved, if you took it out as a dividend or a salary, it would still be cost effective. Even with that national insurance, you've still got a saving. So you kind of feel like it's not that painful.
There's talk about sort of what threshold they would implement it. Wouldn't necessarily be at 13.8. A 2% introduction employer NIC, it would cost, I think, an employer who employed somebody on a 35 grand salary about £17 per year. However, at the full threshold, 13.8, that's obviously much greater, 170.
Yeah.
The other concern is that pretty much makes the tax savings and benefits of salary sacrifice schemes defunct.
Yep.
Why would
that's your only saving.
Yeah, why would the employer want to pay the contribution when they're going to bear the burden of,
So I think you almost think there should be, as you say, two schemes. One for the auto-enrolment shouldn't change or very little. And then those one-off lump sum where we do more planning around.
Yeah.
It makes more sense that's where they would attack. But
definitely. How
many people are doing lump sums right before the budget, Jamie? Loads of people, or is it not really affecting people at the moment?
No. Pretty much every single client who is a corporate client, and most of them typically have December or March year ends. We have spoken to all of them to bring forward that company pension planning. And, as long as the cash flow and the profitability is there and in conjunction with the accountant, it's a good strategy. Well, absolutely, let's bring it prior to the budget. We've been really busy in that sense. It just makes absolutely sense. Bringing forward your allowances and making use of them. It's not to say it definitely will happen, and we explain this to clients, but it's just, you don't want to be caught on the wrong side.
Exactly. Any other changes to pensions, you think, or?
No. So, first of all, you've got the annual allowance, which is the maximum you can pay into a pension. It's currently 60,000. It was 60,000 in the previous tax year and 40,000 in the years before that. The reason why there was an increment was because all of the doctors, consultants were getting the brown envelopes, having significant tax charges. In light of the recent pay award and pay increase, it would be highly unlikely, in my opinion, that they're going to tamper with the annual allowance because within their defined benefit pension schemes, their pension input will be higher than normal. And so I don't think they will tinker with the annual allowance. The pension commencement lump sum or the tax-free cash, there's a lot of left-wing think tanks out there.
There's a lot of conversations about that.
A lot of conversations about that. And it's just reminding clients that when the lifetime allowance, which was the maximum amount you could save into pensions, was reduced, individuals have always been afforded with retrospective protections. And so this comes back to the conflicting debate around why would you disincentivize people to save into a pension when ultimately you're prolonging the state pension age and you're meant to be incentivizing people. And so I saw one of the think tanks say they could cap it at £100,000, but where we've got existing clients, the advice is, we can't act upon speculation. It doesn't necessarily make sense to take that and move it into a taxable arena. Currently, it's considered outside of your estate for inheritance tax purposes. Whether that may change, we don't know. But I do think if they did introduce a tax-free cap, then existing clients would be afforded the retrospective protections.
Fair enough. Okay. And a mention on IHT. We've already talked about CGT rebating, whether they'd possibly get rid of that.
Yeah, I mean, so there has been talk about that. So that's one thing. There's been speculation about whether they'll bring in some sort of lifetime gifting tax. So in a lot of European countries, if you were to make a gift of property or cash or something like that to, one of your children, so in this country, you'd probably be covered by your nil rate threshold. You'd have to live 7 years. In a lot of other countries, they pay a lifetime inheritance tax of 20%, but then it doesn't matter whether you live 7 years or not. You can just give it away. And, it doesn't come into your estate anyway. There has been talk of that. I just don't think that will happen. No. But maybe that's just me. They've frozen them thresholds. The nil rate band has been frozen until I think it's 2028 at the moment. And that has been in place for so long.
It's about 20 years now.
It's been in place for so long. And you think, in years gone by, when I first used to look at IHT years ago, you were really lucky if you had an estate worth more than 325,000. Whereas now, actually, you'd be quite hard pushed not to have an estate worth more than that. So they definitely need to look at that. So I think bringing in some sort of lifetime gifting tax wouldn't really work. And again, I just wonder how they would handle the administration of it. So that's one thing that's been suggested. Whether or not they withdraw business relief has been talked about a lot over the years.
Yes, that's a big one for us.
if they get rid of that, I think the whole AIM market pretty much
That's
collapses.
I don't get how we can do that.
Yeah, a lot of
Yeah.
shares in the AIM market are to get business relief, so I think that crashes that. So I wonder whether they'll perhaps make it more stricter criteria for trading businesses.
Yeah.
At the moment, they say you've got to be mainly trading, so they'll say 50%, whereas business asset disposal relief, they say you've got to be 80% trading. So I wonder if they'll tighten that up in terms of the business relief. But any legislation, like I say, it's so far-reaching that I think it'll just take them a hell of a long time to actually implement any changes. I can't see it coming in immediately. But, watch this space.
I think just IHT talking about death taxes. One thing that I think is pretty much nailed on is there's this current misalignment of pension death benefits pre and post age 75. If you die post age 75, then it's considered outside of your estate for inheritance tax purposes. But when that pension fund is transferred to your nominated beneficiaries, it is taxable as income tax in the year that they access the fund, and they can draw down from it as long as it's in the correct contracts. So that's very important to review. If the policy holder or the pension account holder was to die pre-age 75, then the fund basically circumnavigates the taxman, so there's no inheritance tax, and the fund can be withdrawn in its entirety or can be drawn down completely free of income tax. That is just too advantageous, and I don't think anybody could complain.
It's almost an incentive to die before you're 75 for some people.
When I have a husband and wife in a room, the wife always glances an eye and I say, no ideas there, day before his 75th birthday.
I mean, it's tempting.
So I think that is inevitably something that they will sort out straight away.
Cool. Okay, so moving on to some more financial stuff and what might happen with interest rates, the property market, that kind of stuff. Paul, what are you expecting in terms of, assuming we see increased CGT or generally increased tax rates, what's going to be the impact for interest rates and mortgages and that kind of thing?
Yeah, I mean, the impact on finance is probably slightly less direct than the tax. But the basics of it are that as taxes go up, disposable income tends to drop, and therefore it should have a bit of a drag on the economy and inflation, which hopefully should, if there is a positive to be seen out of it, should lead to reduced interest rates. So from our side, that would be reduced mortgage rates. Fixed rates would fall as well. Hopefully that would add a bit of fuel to the property market. And I might see that pushing forward. I mean, it's been a bit of a volatile, a bit of a strange property market at the moment, or interest rates at the moment. We've seen the high streets sort of competing for market share. That resulted in some lower rates, and then probably recent announcements from the Bank of England have meant that rates have gone back up while other lenders are still cutting. So it's been a mixed bag. But the likelihood is, I think, that we're going to see some form of tax increase to cover the black holes that have been discussed earlier. So, if there is something coming from that, we'd expect it to be reduced inflation and therefore reduced interest rates over time.
Right. So how soon are we likely to see that kind of impact? If we immediately see on the 30th of October, all these rates are going up, so will we see the next day all of a sudden we've got loads of reduced interest rates, or will it gradually kind of? And
I think the reason for the uptick in mortgage rates recently was because the Deputy Governor of the Bank of England came out and said they were going to look to reduce interest rates over a longer period of time. It wasn't going to be a quick cut. So, I mean, everyone's got their own expectations and where interest rates will go to. I don't think we'll be seeing some of the historic rates, the rates that we've seen over the past decades coming back anytime soon. But, the indications are that we've possibly peaked. There is a bit more movement to go down. It's just a question of when that comes in line with inflation figures.
Because at some point, I mean, I've been quite lucky because I think I bought my first house in 2010. For the next 10 years, the rates were pretty low compared to what I've heard they were sort of decades ago. So I guess I should consider myself quite fortunate that none of those were the rates. The last time I renewed on a fixed rate, it was a drastic increase compared to what I have been used to paying. So are we? My biggest concern was if they keep going, we'll be back. When was it when they were massive? Was it the 80s or 90s or something?
You're younger than me, Nick. But look, I mean, interest rates, they're now completely targeted around inflation. They're a key KPI of the Bank of England. So they're a lot more stable than they used to be. Even though the Bank of England does have a bit of a job to sort of try and keep the economy, floating and keep it performing well. But the interest rates should be less volatile. And the reason that there's been such a huge change from where we were, it's the cost of COVID and everything else that came into it. Ultimately they couldn't stay at the unsustainably low level they were at.
Yeah.
So I mean, we're seeing mortgage rates. They've now sort of stabilised slightly around 4% for residential rates. The buy-to-let rates are a little bit higher. But we are seeing a bit more stability. The movements that we saw maybe 2 years ago when the trust budget happened, again, hopefully that's just a one-off and we don't see things like that again.
Well, I was just going to say that hopefully the OBR have actually accosted this forecast. That'll be interesting.
That's the difference, isn't it? This time,
yeah. From an investment point of view, from an investing side, there's what are called safe haven assets, government bonds, and fixed interest, and UK gilts, government index linked treasury bonds. They got hit hard during that time, and there's if you're in a default workplace pension scheme, you would be in one of their lifestyling investment strategies, where as you approach retirement, the FCA and the scheme mandates that you move into these safer haven assets. And we had some calls, not from clients, but from some really concerned people who were originally maybe 2 years away from retirement age, but the asset allocation of their, financial plan was all wrong, and really, really scuppered, and not great. And that was just due to over compliance by the FCA, and not really understanding the real risks of investing, which are to retain the purchasing power of today's money. Because there was so much duration risk in the market for so long. If interest rates are very low and you're getting a yield of 0.25% with limited upside, that is a real risk. And so, let's just hope that this budget is all costed for.
Yeah, I think that's the big thing. How long do they? I think they had to submit their plans to the OBR a week ago or so. So the OBR has a couple of weeks or 2 or 3 weeks to actually review them and make sure they're not doing something completely crazy, basically. We shall see. Okay, so the positives are we generally have more interest rate stability in the market anyway.
Yeah.
We think, or we're fairly certain, tax rates are going to go up, which economically normally means reduced inflation / interest rates.
And certainly the outlook would go in that direction.
Yeah. We're not going to hold you to this. But which arguably means if you've got lower interest rates, more investment into things like property perhaps, and more people buying second homes and that kind of thing because they can now afford it again.
Well, there is also a real drive, I think, within the current government to increase new properties being built to try and increase the property supply. So, again, that might just add a bit of stability to property prices. More investment getting in there. So
okay. Because the one tax that we haven't talked about, or one of the taxes we haven't talked about, is SDLT. Sean Randall was on the podcast with me last time, and we talked various SDLT things, but we're not expecting massive changes for SDLT, I don't think, generally. There have been talks around whether if really things like the super wealthy, I think, more than, those people buying £10 million plus properties in London, should we have extra rates on things like that? But I think generally there's not too much talk about SDLT rates, so I don't think we'll see an awful lot there, to be honest. Okay, so that's some of the economic side of things, which I can't really talk much more about that because I'm a tax person. We've talked CGT, we've talked IHT, we've talked pensions. Talk briefly about we've talked about income tax, briefly because that's one she's pledged not to touch. What other taxes are they not touching? Supposedly, corporation tax. We're not expecting much.
Yeah, they said that the headline rates won't exceed, the current rate, which is effectively 25%, but they may review it in the future. I mean, from an economic point of view, again, I think typically they'll follow other jurisdictions to see if there's any wiggle room.
Yeah.
And to be honest, in the US, they are expecting higher corporation tax rates in the next year, so that might give them a bit of wiggle room to do so. But I don't think that they would move first in that sense.
Yeah, I guess the manifesto basically said we're not changing headline rates. So what does that mean for that 19% rate? Where if you're a really small company, maybe they could do something with that without strictly breaking their pledges. But
it is a confusing calculation.
Yeah.
It's like
you almost think just get rid of it and simplify it.
Yeah, profits under 50, 19%. Anything above, then you've got the tapered
the
figure.
marginal relief thing.
The marginal relief. So it's not clear.
No. So that's corporation tax. Do you deal with much in terms of property investment through companies? Is that?
Yeah, certainly. The majority of buy-to-let investment now is done through limited companies.
Which we see as well because we incorporate property portfolios and things. So
there's no real benefit to retain it in a personal name anymore.
No, because we've got that finance cost restriction for higher rate taxpayers if you're personal. So we'll see. Yeah, I imagine that trend will continue, to be honest.
Yeah, we don't see any reason why that would change. And finance providers now they accept that's the way it's going to be going forward. Yeah. So that there's plenty of finance providers.
I was going to say that's probably one of the big decisions, I guess, when you're thinking, do I invest personally versus through a company, or whether you move your existing portfolio into a company, can you actually get the finance if finance is what you need?
Yeah, so. and finance is there. It's all about taking the right advice up front.
Yeah. So that's positive, isn't it? Because you can basically, I assume sometimes banks want personal guarantees and that kind of thing.
Yeah, personal guarantees. Just a limited liability company wrapper doesn't absolve you of personal liability from a lender's perspective, unfortunately. But yeah, look, the idea is if you've got a sensibly geared property, your guarantee is more a comfort guarantee for the lender to show your commitment to the facility.
Fair enough. So no changes there. So that's all good. I'm just thinking, are there any other headline taxes we want to talk about? So the ones they're not touching, supposedly Nick's, but we're probably going to see something on pensions, income tax, corporation tax. I feel like I'm missing one. I can't remember what the other one was.
National insurance, CGT.
VAT.
VAT, yeah. We're not going to see much there. Private school fees, which we've talked about on this podcast, sort of in the last 6 months or so, but which Labour have always pledged to do. Yeah. It's almost certain. Well, in fact, I think it is certain. We're just waiting for the finer detail, I think, basically on that. So
yeah, definitely.
I know Daphne, our VAT director, is doing loads of work with that. So
it's good to have an expert internally who can deal with these things. So,
but she wants to do another podcast actually on it because there's a lot of information out there and some of it misinformation. So there's not much more to say on VAT. Okay, let's do some predictions. Let's put you all on the spot. Okay, so anything immediate? As in, from the 30th of October, the rate changes immediately?
Not a rate as such, but I think the alignment of the death benefit rules, pre and post age 75 for pensions.
Okay.
Yeah, pretty adamant with that. The national insurance contributions, don't know the timeline, and I don't know whether it will be tapered, but we know that the Treasury have been in touch with a number of the platforms that we use. And so they've been asking if it is something that can be done. So they're my two.
So you're thinking both of yours are pensions then?
Yeah.
Okay, interesting. Have you got any predictions, Paul?
No, I mean, my area is finance. If you're asking me to predict interest rates, that's an area no one really wants to get into. But I don't
try.
I don't think we'll see an immediate cut regardless. I'd say you're probably looking January, February before the Bank of England probably wants to make a cut there.
But you're expecting more likely to go down with interest rates than go up.
Yeah, correct.
Yeah. Okay.
How about you, Nick? Tax expert.
CGT, something's going to happen.
Yeah.
I think all of the talk about business asset disposal relief and getting rid of it has hit the headlines in the last week or two because of that IFS report. And yes, maybe they've considered it as on the back of that, but I'm not convinced that that is just going to be an immediate hit. I think the IFS have suggested that as part of a wider reform, and so we're more likely to see increased CGT rates generally than I think we are to just see them cut BADR on day one. I do think CGT is the one that they could attack immediately compared to waiting till April.
Yeah.
Having said that, if you want to be a skeptic and say that actually they announced the budget so early so that everyone would worry and sell all their assets and all the rest of it, then they've achieved what they want to achieve. And so why do they need to make it immediate?
Yeah.
They could just wait until April and we'll have more people trying to do fire sales in sort of February and March. So yeah, I'm on the fence as to whether it will change straight away. Having said that, something like if they were to get rid of BADR, I do think that probably would be immediate. But yeah, you kind of question. They've always had something for entrepreneurs, whether it's taper relief, retirement relief. My big thing, and I've always said this: if they're going to do something like align CGT rates with income tax, they have to do a reform. They can't just, increase that. Everyone's either, for the smaller gains, yes, fair enough. They'll probably raise a bit of revenue because it's not going to change behaviours. But for those who are sort of selling a business worth, say, 10 million quid, why not just go offshore for 5 years? The £10 million at an extra 20% in tax is £2 million. You can live offshore for 5 years on 2 million quid and come back, or for much less. So there has to be a lot more to it than just a single rate change for CGT for me.
Yeah.
Pensions, we know about the NICs already. I just think pensions is too difficult to make massive changes.
Yeah, it is. And the things I just stated, not the employer national insurance, but the alignment of the death benefits was actually in the 2023 policy paper, but they didn't actually have enough time to implement it.
So they've done the research, they've done the work.
Research,
yeah. So really it's just drafting the legislation.
Yeah, just subject to a finance bill.
So that's that. BPR with inheritance tax. So to get rid of business property relief would be a big change.
Yeah.
Would it be that easy to change? Probably not. As Kate said, it's quite a difficult thing to change such a historic tax. And so again, you kind of think if you want to make such massive changes, you can't just do it. Sort of. This is the first Labour government budget in 14 years.
Yeah.
They've been in power for 6 months or so now.
Yeah.
So 6 months to actually come up with a huge change like that, I think is going to be quite difficult.
Yeah, I think what Kate said, they'll just stricten the definitions of certain BR and AIM qualifying shares, because ultimately we've got lots more companies leaving the UK, list the London Stock Exchange. The last thing they want to do is go and crash the AIM market on their first day in power.
So maybe some smaller changes on IHT. CGT, something will happen, but not much. I think they need to do reform if they're going to really do anything serious. Pensions, you've mentioned your couple. We know really they're not going to do an awful lot with income tax because they can't, because of their manifesto, other than probably freezing. So we have this fiscal drag hit. Corporation tax, probably not. We'll see bits and pieces like with capital allowances. We always see bits and bobs on maybe some R&D. That has been talked about, whether... Because the whole point with the R&D scheme, which we haven't actually talked at all about during this podcast, but the whole point with bringing in a relief to do research and development for companies was to encourage sort of offshore businesses to bring their business to the UK. And yet actually a lot of small UK companies are able to claim R&D relief because of how it's drafted. So possibly, if they want to do something with R&D, go back to that original principle. We're not doing this for, the little person who would be doing this R&D anyway. Let's do something for really big companies to encourage more growth into the UK. Yeah. So
that does seem like one area which has just been abused and is massively in the spotlight.
Yeah. Definitely. It's definitely come under the spotlight a lot more in the last 12 months or so with with so many more inquiries going on into even legitimate claims, HMRC are pushing back on. So, but I think it would make sense to try and develop the economy by encouraging more offshore investment, and R&D is one way they could do that. So that's my little prediction. That's probably a bit more quirky and out there. So, and then just to round it off, it's a little bit late now. We've only got a week before the budget, but what are our big kind of action points if you're going to do anything before the budget? Pensions?
Yeah, pensions, if you're a non-rate taxpayer, pay the 2,000. Sorry, if you don't have income in this tax year, but you've got surplus savings, you can still pay £3,600 gross into a pension account, which only costs you 2,880 net. So you're getting that basic rate tax relief, just in case they ever touch the personal tax relief system. Where we've got companies with December, March year ends, we're bringing forward their pension contributions, in conjunction with the accountant, ensuring that there's the profits and the cash is there. And make use of, ISAs and junior ISA allowances. It's not to say that they will be changed, but, the Labour government could actually foresee, well, you can put £40,000 away each year that's not going to be subject to CGT or, income tax in the future. It allows people to build a nice tax-free pot, and there are a number of ISA millionaires out there. There's quite a number of them now that have made use of those valuable allowances. So it's just making use of your allowances, not doing anything rash, not making any immediate hasty decisions based on what could happen. But it's just being proactive in terms of.
But if you're going to do a pension contribution, it makes sense. To bring it forward,
to do it now.
But there is still time, isn't that's the one thing with they're easier to do than someone who might come to me and say, I want to crystallize my capital gains because I'm going to sell my trading company in the next couple of years. How do I crystallize it? It's doable. We have an idea that we think works, but trying to find a solicitor to do that within a week is going to be a bit difficult to enact it. So it's probably a little bit too little too late, other than those who are already almost all the way through their transaction. And I think the only other thing we're kind of really shouting about to take action before the budget, if you've done a disposal already, which would qualify for business asset disposal relief, is make the claim. Because back in 2020, when they changed entrepreneurs relief to business asset disposal relief, they had what we call an anti-forestalling rule that basically said if you haven't made an election to pay your tax up front, and you'd make an election if you sell shares and you get, say, cash and loan notes, generally your loan note, the gain on the loan note rolls over. So you have to elect to pay the tax up front on that if you want BADR on it. So we're telling people, just in case we do have any quirky anti-forestalling rules, make your elections, make your claims beforehand. Doesn't mean doing your tax return, it just means writing a letter to HMRC to make it. And so those are my big kind of action points. Your pensions stuff, making any claims or elections on disposals you've already made. And if you're already through a transaction, try and get it done before the budget, because why not? Because you're already halfway there. I think that's the main things, really, unless you've got anything to add to that.
No, I think that's all good.
Cool. Okay. And I think we can wrap it up there. So thank you, everybody, very much for listening. Feel free to like and subscribe. We're on Spotify and YouTube at least once a month. We've got a live reactions webinar coming up as part of the Jerem's group. So at 4:00 on Budget Day on the 30th of October, we'll be live talking about everything that's actually happened, which is probably going to be quite a busy afternoon, trying to based on what all the predictions that are going out there. So we'll see. But hopefully, we'll see you and hear from you soon. Thanks a lot.